Danny, I think you have a couple questions from listeners that wrote in, correct?
Absolutely. Yeah, today
Nice.
we're going to be running through a couple of questions that you all have sent in. Let's get to it.
Sure.
And the first question comes from Nevada, Chris, and here
Okay.
it is. So, I have a 401k from a previous employer. My current job does not and will not ever have retirement. What are the consequences of leaving it where it is? Should I maybe move it over into a rollover account?
Okay. That's a good question. So, basically, you're going to have to be thinking of a few things. One, make sure you have access to your 401k online. Before you do anything, definitely recommend you get access to your account online, know what your 401k details are. Like, where's it located? Is it held at Vanguard or Fidelity or Schwab? I mean, where did your prior employer hold that 401k? Do you have access to it? Are you able to log in and get details on it? What are your investment options? What are the fees, right? Before you make any decisions, you have to know what you currently have and be able to weigh the pros and cons. First thing I would do is get logged into it. Second thing, contact your prior employer and ask for a summary plan description. So the summary
that
plan
has to come from the employer and not the 401k provider.
Right.
Okay.
There's some interesting terminology that gets used, and I'm not always perfectly up to speed on what they mean. I believe it's your plan sponsor, which is usually the employer that sponsors the plan, right?
Okay.
So they usually should have somebody, maybe in HR, maybe they have a contact to a rep for whoever's holding the 401k, to give you a summary plan description. And that's going to go over, it's going to spell out all the fees in the plan rules, what the plan allows, what it doesn't allow. For example, I don't know how long ago you, our listener, moved to this new job that doesn't have a 401k, but some plans don't even allow you to keep your funds in there if it's below a certain dollar amount. Like if enough time passes and you're below a certain dollar amount, they'll just mail you a check. And that could even have tax consequences. So you have to be mindful of that too.
Okay.
So
that's something to be aware of.
Yeah.
I think in this case, they probably haven't received a payment.
Well, hopefully not. Yeah. So yeah, just you want to know what that 401k offers you in terms of investment options, fees, and then just see how that compares to what your other options are. You know, wherever you might open a individual retirement account, and that could be, there are all kinds of places. I mentioned, Fidelity, Vanguard, and Schwab. Those are the first three that came to mind, but I don't have a bias towards those. There are literally several options you could choose. The biggest thing is to be careful.
This segment brought to you by Fidelity.
Oh my God.
No, I'm kidding.
Definitely not. So be careful with the rollover. There's something called a direct rollover and an indirect rollover. So
Great call out.
Yeah, so you want to make sure you're doing it right. You want to make sure it's a direct rollover. Definitely, if you decide you're going to roll over your old 401k to your own individual retirement account, you want to contact that place where you're rolling the money to and make sure you get someone on the phone that's going to help you nail that process perfectly. Like, you got to make sure that the check being sent is to the new custodian, not directly to you. It should have your new account number that is going into. You have to get those details just right, because if you don't and you end up doing an indirect rollover, there are different rules that apply. With indirect rollovers, that's usually where they send you a check made out to your name, and you only have 60 days to get it properly deposited into a new retirement account. But there's even another catch. When they do an indirect rollover, the prior plan administrator, they are required to withhold taxes from that check, usually 20%. And
that hurts.
Yeah. So for an example, like let's say you had 50,000 in there and they send you the check for your 401k via an indirect rollover. So the non-proper way, they'll send you a check for 40,000, not 50, because they had to withhold 10 for that 20% taxes. And then you only have 60 days to roll over that check directly into another retirement account, but not just the 40. You actually have to make up the additional 10 they withheld, even though they already sent it to the IRS. You have to, in full, the full amount that was sent out, distributed from the 401k, you have to come up with the additional 20% out of your pocket to make sure that gets into account. If you don't, you're not only hit with taxes, but you're also going to be hit with that 10% penalty if you're under the age of 15 and a half. So
make sure that it's a direct rollover, and the former 401k provider is directly sending those funds to the new custodian.
Yes.
All right.
Get on the phone with the new custodian, have somebody walk you through that process. Make sure you get it done right.
Got it.
Yep.
All right. So moving right along,
Okay.
we've got second question. This one comes from California.
Okay.
It says, recent purchase of a home. The interest rate is nearly 7%, costing $4,000 in interest per month. What are your thoughts on paying extra towards the principal versus investing in a taxable brokerage?
Wow. Okay. So $4,000 a month in interest is high. And 7%
Just a little bit.
is pretty high too. So going back to this listener, if you have not listened to episode 5 where we talk about debt repayment as an asset class, definitely check that out. 7% interest rate is pretty high. And you have to ask yourself, if I'm paying off this mortgage more aggressively, making more payments towards the principal, I'm getting a quote unquote 7% return, right? Guaranteed. That's the interest rate on the debt. Ask yourself, can you reasonably expect to get that kind of return elsewhere with no risk, right? You'd have to probably take on additional risk to get that 7%. And let's add another caveat here. You were asking specifically about investing in a taxable brokerage account. So now you have to account for after-tax return, right? And if you're you said California, right, Danny? So if you're in California...
yeah, sorry for the wait. Yes.
Oh, that's okay.
In California.
Yeah, so if you're in California, you're probably in a high state income tax bracket. And if you have a house that's $4,000 a month, you're probably also a high income earner. I don't know for sure, but I'm going to make these assumptions. So let's, for simplicity's sake, let's say you are in a 24% federal income tax bracket and maybe 8 or 9% at the state level. So we'll say 9. 24 plus 9 would be 33%. So in order to get a after-tax 7% return in a taxable brokerage, accounting for those tax brackets, you're probably talking close to a 10.5%, almost a 10.5% return you need in a taxable brokerage account to account for the taxes you have to pay on that gain to then have a net yield of 7%. So you might be in a good position. I know it's kind of boring, right? Like people want to invest in awesome things and feel cool about their investment portfolio. So I'm not going to tell you what to do, but I can't fault you if you decide to make extra payments towards that, because that looks pretty enticing at a 7% interest rate, especially when you account for an after-tax equivalent yield.
Absolutely.
Yeah.
Quick call out. I just threw in some kind of average California numbers going off of 7%. And if you were able to put $1,000 a month extra towards principal over the life of the loan, you'd be saving more than $400,000 in interest. And it would shorten a 30-year loan by 12 years.
Yeah. Oh my gosh. That's a cool shout out. I have one more quick shout out and then we'll wrap up for our listeners,
Yep.
Danny. For this mortgage example, I don't know what your balance on the mortgage is, but generally speaking, you're only allowed to deduct mortgage interest on the first $750,000 of your mortgage, generally speaking.
Okay.
So I don't know if you're itemizing deductions or taking the standard deduction. Just be mindful of that. In reality, if you're making aggressive payments anyway, a lot of the interest is already baked into the front end of the loan. So you may not really be missing out on that mortgage interest deduction as much as you'd think. So I still think it's a strong case to consider it. But
Great.
You have to just look at your preferences and your situation and see what you think is the best decision for you. So
Awesome. Well, thanks for answering those 2 quick questions.
Absolutely.
Everyone listening. Hope that you enjoyed it. And be sure to listen to the full episode coming out this Thursday.